Gregg, I have something to update you on, and it is that we're live on Facebook for the Tuesday edition of the Not Your Average Investor Show. I'm your host, Pablo Gonzalez, leading into the camera for the first time in a while because we've been in studio. Really enjoy that thing. With me, as always, the man that I call GC, that you call GC because of his genius concepts, because he generates cash flows, because he's a great co-host, and because his name is Gregg Cohen. Say hello, Gregg.
Hello, everybody. I'm here from Flight Control Central with my air traffic controller headset on. We are ready to rock and roll and bring the real estate update to you.
Ready to rock and roll. Gregg, are you concerned at all that the energy that you're giving off from this office is going to light the office on fire right now? Have you ever been in public doing this before? Are they going to look at you funny?
I'll tell you, the energy comes from the office. I think it's just going to amplify the show. We've got all of the best of all worlds combined here. We're going to have a great show.
I love it, man. I love it. I love that JWB energy. All right, man. Gregg, this is the quarterly client update. Not the quarterly client update. This is our quarterly market update, right? Where Q2 is upon us. We're halfway through Q2. Hard to conceptualize how quickly the year has gone. Little update. CDC just lifted restrictions, right? So it seems like the world is getting back, but I think right now is a good time to look at what's happened in the last year, to look at what's happened in the last 2 years, actually compare it to what's going on right now, get a snapshot of the macro economy of everything that's going on in Jacksonville, which is by all intents and purposes, the hottest, if not, top two hottest real estate markets in the United States. And JWB, with their data flywheel and their many, many, many data points, has a unique take on it, man. You ready to jump into it?
I am. I think this is going to be a really cool time for us to look at the numbers, because now, for those who have been fans of the show for over a year now, you're going to see us reference the same types of metrics, the same types of data points that I told you to look at in all types of economies and all types of environments. And I said, this is how the real estate market is most likely going to be impacted. Now we have some ability to look back. It's been a year and a half since COVID really broke here, and we're able to see certain things happen. And so it's going to be a great learning opportunity. I mean, the point of the show is not only for current clients who we love having on the show, but for those of you who are just interested in how to invest and how to learn more about the Jacksonville real estate market. You're going to see actual data with the connection point that we've made to like what actually is going to happen. And now you're going to see that a lot of it's happening. So I think it'll be a great show. And for all of our current clients, we got a lot of great news to share with you. Those who own rental properties, the message that I've been sharing for quite a long time now is that this is the very best time to invest in rental properties, in my opinion. And for all of you who have bought and are holding on to those assets, like I share my advice for you to do, you're going to be handsomely rewarded.
Yeah, man. And I think I'm just thanking Lee over here because he's sending me a private message saying that it's impressive how not rattled I am. That don't let the book cover fool you, Lee. I am very rattled underneath here. But I think it's, speaking of rattled, right? I forgot to say a couple of things. One is that this is an interactive show, right? Like we want you driving this conversation. Gregg is going to be reporting on some metrics and stuff, but we want to clarify, we want to contextualize to you and what you're looking for. So 2 ways to interact. Number one is the chat. When you first default into the chat, it's only defaulted to talk to us with that little blue box right above where you type. You got to change it to panelists and attendees, and everybody else can see what you are writing so that you see all the brilliant takes by Lee and Jen and Sergio and Nadeem and everybody else that is a seasoned real estate investor. Marilyn, welcome, Marilyn. Good to see you. And second is, if you want the question asked, pop open the Q&A. That's a different box that you open at the bottom of the screen. And that's the best place for it to be right in front of my face, and I won't miss it, and I won't, get rattled and lose that. And last but not least, if you go to nyais.com, you see all the past episodes. You see everything that we've worked on in the show, and see it in podcast form, see the blogs that we're writing about it. And if you like what this market is doing and you want to get in on it, go to chatwithjwb.com, hop on a call with Courtney and the sales team. They will start to talk you through how you get into the game here in Jacksonville and take part of this amazing upside that's happening right now. So Gregg, I'm gonna share the update right now. This is also the last thing that I'm gonna add in here haphazardly, is the idea that This comes from a quarterly call that JWB gives to their clients and their investors. We had one for just clients and investors yesterday on Monday, and this is going to be a recap of what we talked about yesterday. So just a little perk of being a JWB client, which I now am, as everybody knows. Oh, we closed on our second property yesterday. I forgot to
We
say.
did?
Yeah,
Shoot.
man.
Me and you were hanging out yesterday. We were hanging out this weekend. We didn't even talk about this, man. Congratulations.
Thanks, man. Thanks. I got 7171 lucky, man. That was a show right off of the property of the
Week. Absolutely, man. That's great.
Yeah.
Congratulations.
So I officially have a real estate portfolio. All right. So this show is not about me. It's about you. All right, Greg. Tell me what's going on with JWB as a company. We got these stats up here. 2019, 2020, 2021. Properties purchased went from 592 to 627 to predicting 1,021. What's going on there, man?
Well, let's just kind of put some perspective around this, and I'll kind of break down what some of these numbers mean as far as JWB's overall strategy. 2019 was the best year in JWB company history. We purchased 592 properties, started 430 new construction homes. Sometimes we just kind of skip that number in the midst of a lot of other big numbers, but to start 430 homes in Jacksonville, Florida, if all our business did was build new construction, we are one of the top 10 builders just for building houses in Northeast Florida. So a big credit to our new construction team there. So 430 houses that are new construction started, 130 renovations completed, and about 400 turnkey property sales. As I mentioned to you, that was the banner year for JWB. So that's not, when you see some of these numbers that you see in 2021, I don't want you to think that like that's a ramp up year. Like that is what we had been building this organization to do for the last, call it 15 years, is to get to that spot, and super proud of the accomplishments of the team. A couple other things to point out though. You'll notice that we purchased 592 properties and we sold about 400 properties. Pablo, you heard me talk about this on the call yesterday as why we do that. Many times if you're a business, you buy assets and you want to sell them, as quickly as possible, right? You buy inventory and then you want to sell that inventory. Try to maybe go a little bit bigger picture for JWB. Why do you think JWB believes so much in owning and eventually selling rental properties versus other types of properties, ones that maybe we would buy and then flip to another homeowner who's going to move into it? Why do you think our core business is built around loving turnkey rental properties?
Greg, I feel like you're asking me a question that I have like 30 answers to. When being part of the show, one of the things that stands out to me is the idea that you started this company in 2006. And in 2006, you were doing a couple of different things in real estate. As we all know, shortly thereafter, real estate got slapped around pretty good. And it was the turnkey rental income properties that you all realized that everything still performed no matter what was happening. Mm-hmm. So that's the first thing that comes to mind. The second thing that comes to mind is what I've been talking about recently and on the show and bragging to my friends about it, is the idea that as a company, because your inventory provides returns for you, like your inventory makes money for you, it allows for a really, really unique strategy of long-term thinking and planning that allows you to build a company based on your core values. Those are the first two things that come to mind.
Exactly, brother. That both of those points are very true. The second point is so critical. What I'm sharing, my love of this asset class that I'm sharing with all of you, and why I get so passionate about helping you build your rental property portfolios, is because that same portfolio, that best risk-adjusted return on investment that we're talking about for you, whether that's one property, 3 properties, 10 properties, in essence, that's the same reason that JWB loves this as well, right? When we buy 600 assets this year, or in 2019 like we did, we have the ability to hold on to those assets, and they produce rental income that cover all of the expenses. And then we can keep them in our inventory for a later timeline when we knew that inventory was going to get scarce. So normally when you look at a business and you're buying more than you're selling as a business, that's probably not a good thing, because you don't have a way to make that inventory cash flow. It's just costing that business. But if you think about it on let's call it a micro level, when we're talking about with Pablo, your 2 properties, the first thing we talk about is the fact that this is producing positive cash flow for you. Well, that's the first threshold to get to. Well, that's also why JWB is able to go ahead and buy so much inventory, buy more than we know we're going to sell that year, which helps for the runway for future clients to be able to purchase in the future. So it's that same micro, if it's with your portfolio, what we're talking about as far as cash flow and how important that is, that's the same thing that we love as an entire business. In addition to that, right, 600 properties there that we purchased in 2019, those aren't all properties that are built today, right? A lot of those properties were properties that are just lots. And we knew that buying lots, we've been doing this for over a decade now, buying lots and sitting on lots was going to be a good idea. That's why for really over the past decade, we bought more properties, even if they weren't built yet. We bought more lots than we knew we were going to build that year, because we knew at some point, which when I share the market metrics with you in a minute, you're going to see that inventory is going to be incredibly scarce and prices are going up. And if you can already own the land and already been at that lower cost basis, then we still have the ability to provide cash flow positive properties for clients later on. So this idea of where the market is today and where I'm going to share the data with you here. Now, it's gone up a lot in the last year, even more than we expected. Nobody anticipated COVID. But at the end of the day, 10 years ago, when JWB started to go down this path of buying more inventory, it was built on this expectation that we'd be at a point where everybody else couldn't get inventory. And at that point, prices were going to rise. And how great would it be for JWB and for our clients to be able to have that inventory in our possession, start to build it out so that we can meet the needs of clients and really separate ourselves as a company from everybody else.
Makes a ton of sense, man. It makes a ton of sense. And like you see these numbers here, and I know after having gone through the call yesterday, I know that these numbers and this big leap in properties and what's going on is a reflection of many, many years of preparation, right? Like many years of preparation to capitalize on something. But I'm going to go through the rest of the numbers, right? So properties purchased is going up astronomically. The new construction home started 2019, 431, 2020, 281, 2021, back up to 400. Renovations completed 132, 2020, 98, 2021, back up to, dropped again from 2020 to 88, 2019, turnkey property sales 397, 2020 421, that's growth, and then 2021 800, right? So that's what's being forecast. So what I see here in these numbers is two things. Number one, I see the idea that that there is going to be a large movement of land going into JWB's coffers, and there's going to be a large movement of properties going into investors' coffers, right? Into investors' portfolios, while the actual construction of it all, 2020 took a dip. I'm assuming that is the logistical issues of COVID, of people showing up to work sites, and the new construction is ramping back up while renovations is kind of like staying down, again, assuming because the market is so hot. You want to kind of handle that?
I think you're on point with a lot of that. I'll clarify a couple of things here. So let's talk about the year 2020 overall. When COVID broke, everybody was scared, right? Everybody in the world was scared. I was scared because nobody had ever dealt with anything like this before. And the first thing that my business partners and I did was we called an emergency meeting when we understood this, and we went to our business plan that we had just built the previous October, and we started slashing. And we said, what can we count on to produce revenue in an environment where the world is flipped upside down? And those 400 sales that we had in 2019, that didn't even factor into the number of sales we were projecting in 2020, right? We went way low because we had no clue. And the next thing we did is we went and we looked at our capital reserves and our other revenue sources. And we said, let's make sure we can protect our team first and foremost. And once we knew that we could do that, we got to work to make this the best situation that we possibly could. We then went to our team and said, guess what, everybody, nobody is going to lose their job, even though the world's turned upside down, because we knew we needed to take care of the team first. When we took care of the team was going to take care of our clients. And that has portrayed that's worked out quite nicely. But the reality is that I never expected to see these numbers in 2020 at the depths of COVID breaking. So to be able to look at the business at the end of the year and see that we purchased 627 properties, we started 280 new construction homes, renovated 100, and sold 420 homes in 2020 is, I think, reflective of a few things. Number one, your JWB team is full of rock stars, full of talented individuals who really care and who overcame and are continuing to overcome incredible challenges that COVID brought to everybody on the resident side, on the client side, internally, systems wide, going remotely, wearing masks, things changing. I mean, for a team to produce that way, we're just very, very proud of the team. But the other thing here is that this is a statement about this asset class, right? Investors are going to look for the best place to put their money. And what we said early on, even when COVID was breaking, is that we felt that this asset class is built on a critical need, and it's good to be investing in a critical need when the world's on fire, right? Housing is a critical need. It's a critical need for the individual. It's also a critical need for the government to make sure that housing's in a good place. And so we felt that this asset class would perform more consistently. We also looked at the data and we felt that we didn't see home prices dropping, even though the world again was on fire. And we said that this was the best place to put your money if you have similar goals to our clients. And so to come out of 2020 and to see these numbers and to see a new world record for JWB in terms of property sales, I think is reflective of the strengths of this asset class as well. You saw a lot of things start to transpire as far as people making sure that they were, of course, paying for housing first and foremost. That's what people do when, their livelihood is threatened. They pay for shelter, right? And you saw the government step in with a lot of stimulus that specifically went to people paying for housing. And that's just not the same that you can say across a lot of other asset classes that dealt with a lot of losses and volatility. So when you look at 2020, an absolute banner year, I never would have expected to say that 2020 was the best year in JWB company history, but that's how it turned out.
Yeah, man. And when I look at this, I look at these numbers, the thing that sticks out to me as far as storyline in this show that our friends that are here are what we're a part of was when COVID broke out, you showed up and you said, I don't know what's going to happen in the short term, but I can tell you that at JWB, we are bullish on real estate prices, long term, and we are buying homes, right? Like we are buying properties. Look at what we are doing. And that's, reflected here in 2020, right? Like obviously the construction slowed down, the renovation slowed down, but you didn't slow down in purchasing properties, right? And you're definitely not slowing down in 2021 in purchasing properties, which again tells me that as an investor who's parking my money with you, it tells me that it's kind of what Margaret put here in the chat, that I'm walking the walk. You guys are walking the walk, right? Like the idea that you are continuing to purchase the long-term piece, which is the property, makes me think that this 800 number of 2021, that's not the only year that you're thinking that you're going to have a lot of sales for 1 year. You are looking 2 to 3 years out and thinking that at least in that time window, it's still a good buy.
Absolutely. It's really nice when you are thinking about putting your money with somebody to see that they are putting their money there too. There's just no substitute for it. We've been doing that for 15 years in an environment in 2020 where, again, all bets were off, completely new world for everybody. We stuck to the same fundamentals. We saw an even bigger buying opportunity in 2020, especially as it started to transpire and we started to figure out the effects of this on the COVID economy. We saw inventory levels dropping. We saw interest rates dropping, which led to higher demand. It became then a race for JWB to acquire as much as we could because we saw other people, the entire world now is on to this beautiful niche of investing called rental property investing. And you're starting to see that in the number of sales this year. We expect it to continue in future years. And now our challenge is, how do we make sure in an environment where sales are going up so much, how do we still stick to that belief that we want to be able to provide inventory for folks in a market like this for 2 to 3 years? And you can see we're starting to do a pretty good job of that in 2021 as you see that we are actually on pace to purchase over 1,000 properties, which will be a new JWB world record by a long shot.
That's a heck of a record, man. I'm going to go into Lee Bishop has a question here. He says the 250 plus properties which I'm assuming he's talking about the 2020 new construction homes started. Are they done and waiting for occupancy permit, or is it waiting for other permits?
I think he's probably looking at the 250 lots that are waiting for permits from the building department.
That's right.
Yeah. Yeah. So I'll kind of go through the process here. JWB, of course, buys the lot, right? It might even be a lot purchase we just purchased on yesterday. It might be a lot that we bought 10 years ago, right? At some point, we fire up that lot to go and get a permit. Normally, that process of getting a permit in non-COVID times has been maybe 30 days to get the permit returned back to us. And then after that point, we do about a month to 2 months worth of work after having the permit to do the site prep, to make sure that we're doing all of the things on the ground so that our builder can just go and go vertical with the house. And at that point, that's when we start to make the inventory available for clients. And usually once we go vertical, it's usually maybe a 3-month to 4-month timeline from the time that the house is actually finished. And of course, that's when the client would actually close on the house is rented, and it becomes this performing asset. So that's the overall timeline. And that 250 lots that are in permitting from the building department is way early on in the process, right? Now, and of course, JWB has all of these hundreds of lots that we've been sitting on. We have put those into the process that normally takes 30 days, maybe 45 days to get kicked back with a permit. And now it's taking 75 to 100 days or more. And so there's this incredible backlog of permits that the building department in Jacksonville just cannot keep up with. And that is having an impact on inventory in the short run for JWB, because we're not going to make it available for clients until we control those variables, get the permit, and then of course do the necessary site work. So that's why inventory has been lower in the short run. It's really a production issue that's held up by the building department, which unfortunately a lot of that's out of our control. So those 250 lots are waiting for permit. Once we get those permits, they will join the rest of the lots that are in the site prep stage. And then once we get past that stage, then they'll become available inventory for us.
There you go. All right. Let's move on here to, so clearly JWB as a company on fire. Let's talk about the housing market. We got some questions from Jen and from Lee that apply more to the market itself. So we're going to get into that, Jen. We're going to get into that, Lee. Let's talk about this housing market pricing data, right? March 2019, median sold price, $235,000. March 2020, median sold price goes up about $8,000. That's probably about 33%-ish. And it goes up to 243. March 2021 goes up another $30,000, significant jump to 274,950. Median days on market, March 2019 from 43. Median days on market 2020, 38. Goes down by 5, about an eighth. And then median days on market, March 2021 goes down to 20, almost a 50% cut right there. Number of sales, again, similar things. We're seeing 2019 to 2020 take kind of like normal variations, and then 2021 astronomically leap. Number of sales goes from 2,300 to 2,700 to March 2021, 3,400. And then the big one is the appreciation rate year over year, where March 2019 went to 3.6, 2020 was 4.12, and then 2021 almost 12%, 11.93. What can you tell me about this stuff, Gregg?
Well, let's just put it in perspective again. In March 2019, this is what we would call a normal real estate market. It's a typical market that you would expect higher than normal home price appreciation in the short run. Our median home sales price, $235,000. That's below the national median. Last I checked, the national median was about $360,000. So that's why investors love coming to Jacksonville, because we have lower home prices than what you would find in the typical market across the country, and we have high rents. And 43 days on market. DOM stands for days on market. 43 days. That's a really good moving, real estate market there. 2,300 sales is actually one of the higher sales numbers that we've had in Jacksonville's history in a month. We had actually never been above 3,000 sales in a single month prior to June of 2020. Had never happened. And then your appreciation rate, about 4% there. I mean, that is a really strong real estate market. And that was the message that we were delivering to clients back then. I mean, again, that's why we were so encouraged to be buying as much as we did, because we expected real estate prices to go up at that point. So I don't want it to seem like when you start to see the numbers of 2021, I don't want you to see back in 2019 and feel like that was not a moving real estate market. It really was. As you start to see March of 2020, again, this takes into a little bit of the COVID effect. COVID really kind of became ground zero here in the States around the middle of March. So this takes some of that data into effect. But a lot of the decisions that were made that show up in sales were made by buyers that made the decision in February or even January. So pretty reflective of kind of a lot of this prior to COVID. Median home sales price, again, going up about 4% for an appreciation rate year over year, 2,700 sales, still moving, and days on market continuing to go down. So that when you say that March 2019 would have led to higher than normal home price appreciation in the short run, you saw that reflected 1 year later in March 2020. Now, in March 2021, I've been doing this for quite a while. I've never seen a market moving this quickly. And you talk about the effect of COVID and how it is accelerating things that were already happening in our economy and our way of life and investments, right? Well, you are really seeing things start to really jump as far as pricing in Jacksonville specifically, in other markets too, but specifically in Jacksonville, there's not a market that has been better suited for home price appreciation than a market like Jacksonville, where you have incredible amount of population growth even prior to COVID, and even more now that people want warm weather. They want to be in a place that has a lot of distance. They want to be able to buy a single family home rather than renting a studio apartment in other parts of the country. All of these people are untethered from their jobs. They want to live in a community where there's a beach and no state income taxes. So you're seeing all these things happen, and it is creating some really substantial gains on pricing. So our median home sales price in March up to $275,000, again, still below the national median, which is important to note, but rapidly growing. 20 days on market is way low. And 3,400 home sales in a March is absolutely a record by a long shot. I mean, you don't see 20% growth in sales year over year. I've just never seen that. And because there is such low inventory, which I'm sure we'll talk about here in a minute, low inventory, high sales means prices go up, especially in the short run. And 12% year over year appreciation is even more than we predicted last year, even more than we predicted this year. We expected 8 to 10% appreciation in 2021, and we're on pace to outpace that.
It's epic, man. I mean, when we're looking at this and, we think of the fact that the effect of COVID hit midway through March, right, in that market, and the market was already doing pretty well, right? Like it year over year, 2019 to 2020, they had already done well enough to outpace the year before. But to think of what's happening now, it's clear to me on two levels. One is from the resident factor, and then the other one is from the person that moved here factor, right? And as somebody that moved here from one of these markets, that is, like you said, median home price here is $274,000. I did not know that $360,000 number, but as there's a clear macro trend of people moving into better climates. There's a clear macro trend of information being widely available. So when there's a good deal out there to be had, people know about it. And this idea that we thread that needle of really, really good climate, really, really high quality of life, really, really good cost of living. I haven't been shy to say that Jacksonville, for me, in the last moving here 3 years ago, has over delivered in every aspect, from opportunity to who my friends are to everything else, right? Like not just in cost of living. That's the macro trend, and then the micro, the microwave trend of COVID, which you can look at as a short-term thing, but really, I think most educated forecasters and market observers don't think that COVID really changed much as just accelerated a bunch of things, right? Like this idea of being untethered from location to be able to move, right? Like when I moved here, I had to find an opportunity to move here with, right? Or take a major gamble. Nowadays, people are able to move here without giving up their job, right?
Exactly.
Without that part, right? And knowing that there's going to be this interconnectivity. They just lived in this world where their family was only a 45-minute drive away or a 20-minute drive away, but they didn't see them for a year except for Zoom, and it became normalized, right? So like the untethering, the geographical untethering of the workforce and the social dynamic is something that may seem like a big spike right now, but it's not going away, right? Like I think it's going to continue to drive people to these places where the deal is good, the quality of life is good, and you know the pain of distance from what you're used to has been permanently reduced.
Yeah, I think that's a big question. If you're putting your investor hat on, you're saying, wow, is all of these sales, all of this population growth an effect of COVID, or was it there before COVID? Right? Because if it's only because of COVID, then you would think once COVID is over, then the sales are going to drop back down, the demand's going to drop back down, right? Months of inventory might go back up, and then, a lot of things could change. What people don't realize is that, Jacksonville has been one of the fastest growing cities for a while here. In 2018, we were ranked the 6th fastest growing MSA, which is another fancy way of saying city and the surrounding areas. MSA stands for Metropolitan Statistical Area. It's the way you measure different communities across the country here. We were the 6th fastest growing MSA in 2018. Right. And before that, our population has been growing, one of the fastest growing populations in the state and in the country as well. So that just gives credence to your point there, where COVID did not start this trend that people are going to want to move to Jacksonville. It accelerated it. And when you have population growth over the long haul, that's demand for housing. At the end of the day, that's why Jacksonville has been known as a growth market over decades now. It's because they make the same decision that Pablo made even before COVID, which was, I want to live in a place where there's a beach, where the weather's beautiful, there's an outdoor lifestyle and a way of life, and it's sunshiny, and there's no state income taxes. And, and that's we would expect that to continue even when COVID, runs its course.
Yeah. And you don't have to be wealthy to live there, right? Is the second caveat, right? Because there's plenty of that, right? Like I moved to St. Barth. Yeah. or Bermuda or something like that, right? But like you don't have to be wealthy to live there, man. So yeah, I totally agree, man. We got a couple of good questions here that have to do with the demand side of the equation and the macro trends. Lee Bishop asks, Gregg, how are the prices of new houses going to affect the renters in neighborhoods that are C-class with these more expensive houses in these neighborhoods?
Great question. So I think at a large scale, this question's about home price affordability, whether that is home prices or rent prices, right? And this is a big issue for the entire country. I think everybody needs to pay attention to home price affordability. I mean, that's one of the big reasons that our charitable organization, JWB Cares, our mission is to help with affordable housing. It's because we believe that this is an issue that everybody needs to pay attention to. And if the reason why, if I'm only just putting my investor hat on, the reason why I care about home price affordability is because we talk a lot about supply and demand. We talk about low months of inventory, right? If there's low supply, you're probably going to see housing prices go up. Well, if homes no longer become affordable, I don't care what supply is, because if people can't afford to pay more, then you're going to put a cap on what the home prices would be. And as investors, we don't want to put a cap on things, right? We believe internally here, and one of the reasons why we do so much to help our community and to help the local economy and downtown is because we think we can have the best of all worlds. We think we can have housing prices go up and median incomes go up to support higher housing prices, and then everybody can win, right? And the reason that the way you do that is you make an impact downtown, you create places for people to want to live, you bring millennials and other high earners into a downtown, urban, walkable, thriving downtown, better jobs come, and that's how this whole entire flywheel works. So home price affordability is something that I think we all need to pay attention to. And this is one of those issues that, we pay attention to as a vertically integrated investment company. This is one of those problems this is one of those what's coming next problems to solve. It's not a problem like today in Jacksonville, but it's what's coming next. And it's us wanting to take care of your money over a full real estate cycle 10 to 20 years from now. So I do think it's a big thing. The reality, though, is that Jacksonville, just as you mentioned, Pablo, has a low cost of living. Homes are affordable here, much more affordable than they are in other parts of the country. You know, you hear of San Francisco and other high-priced markets, and they have real issues. Even in Miami, it's a real issue. Home prices are so high that they can't bring the talent to come to want to live in Miami because they have to live an hour and a half away just to find a house that they can afford, right? So at some place, home price affordability becomes an economic issue for the entire community. But Jacksonville has a much longer runway than other places in the country. And so what you're seeing, to get back to Lee's question, you're going to see home prices go up, right? You're going to see home prices go up, especially, you know, for non-investment properties, right? Home prices are going to go up based on what people can afford to pay. For investors, for us, we still are limited by a return on investment and positive cash flow. So there's a little bit of a different dynamic there, but you're going to see home prices, new construction properties, the price is going to continue to go up. The interesting thing, or the good thing as an investor, is that you're also seeing significant rent price growth. And so you can still make positive cash flow as you have home prices going up, you know, depending on how much they go up, depending on how much home prices go up and how much rent prices, it'll be determined as to how how long-term that affects positive cash flow. But home prices are going up, rents are going up in Jacksonville, and I would expect to see that on new construction homes and renovated homes from JWB in the short run for sure.
Yeah, that makes sense, man. And to your point, you know, not all Florida is the same Florida, right? Like you talk about Miami and you talk about these other markets. In Miami already had this issue, right? Like Miami was already too expensive for my wife and I, who made a combined income of about 175 grand to feel that we were comfortable in, right? So we moved to Jacksonville, and Miami has also benefited from the Texas, right? Like this whole like moving to warmer climates. And I was just there last week, and I've heard that in the last year in COVID, prices that were already almost unbearable for the average worker, right? If you want to call a combined family of 175 grand a year, an average family was already really burdensome, have tripled, quadrupled. You know, it's gone way up because of all the tech bros and their Silicon Valley money coming to Miami first, right? Like while Jacksonville is still very livable, right? So like, you know, Jacksonville still has so much more to go. And it brings me to Margaret Smith's question. What is JWB's medium home price? Should be lower, right? Bread and butter houses than this medium home price of 274.
Yeah, absolutely. You're right on the money there. So our prices will be between 150 to 250,000, with renovated properties being on the lower end of that pricing and new construction properties being on the higher end of that pricing.
There you go. So we got a couple more questions that we're saving for when it's more applicable. Jen and Denny, we're going to get to yours, but right now let's talk about your favorite stat, Gregg.
Oh man,
the Gregg Stradamus stat right here, where he predicts the future, where we talk about the inventory, right? Like the inventory in 2019 was about 8,000 homes. In 2020 was 8,200 homes. 2021, half that, less than half that, 3,600 homes. Total sales happening in March 2019, 2,300. Total sales March 2020. 2,700, you know, a leap of $400 and 400 houses. And then 2021, 3,408, right? Like big leap, not as big as all these other big leaps that we're seeing. But then we look at, when you juxtapose that to the amount of inventory on market and the sales having gone up, it makes months of inventory look crazy, which is 2019, it was at 3.44, 2020 was at 2.97, and April 2021, 1.08. Gregg, tell me about your favorite statistic here in months of inventory, buddy.
You know, I've never loved this statistic more because you know, you have conversations. We're all relatively interested in real estate here, some of us more than others, but I'm sure you have these conversations about housing in your area, in your local area. And I'm sure you're talking with your neighbor, your friend, your family member, and everybody's saying, man, housing's on fire. It's crazy. It's crazy. Well, months of inventory is a numerical way to quantify that conversation. It's a wonderful thing. It helps us understand how many months it would take for us to exhaust the current inventory on the market. And the beautiful thing as investors is we can look back over time and see what this number has come out to and how that correlates to home price appreciation in the short run over the next year or so. And there's a strong correlation, which is really cool, because then as experts in this field, JWB can use this information to help you prepare to help you know what's coming next, and also for JWB to prepare to make sure that we can provide access to inventory and opportunities for you. So we love this metric. This is one of the two metrics that we look at most often to see where home prices are going. And it's something that we have referenced on this show since the very beginning. Even before COVID, we were talking about months of inventory and what it means. This metric, more than anything else, was the basis of why I came strong and said that I did not see home prices falling when everybody else said they would back when COVID broke. And here's why. So looking back in March 2019, you can see 8,000 houses on the market. 8,000 houses on the market is not a glut of houses on the market. To put it in perspective, in 2007, we had 16,000 houses on the market in Jacksonville. That was a very different time, right? That was before the Great Recession. But just to show you that 8,000 is not this huge glut. 2,300 sales, again, that's a rockin' real estate market here in Jacksonville in a month for 3.4 months of inventory. Historically, if you see between 6 to 7 months of inventory, that would lead to normal home price appreciation in the short run. I'll call it over the next 12 months or so. Normal home price appreciation, you can go back and actually research this in your local market. In Jacksonville, over the last 30 years, on average, we've appreciated at a rate of 4.3%. And so you can actually line that up and say, well, if we see 6 to 7 months of inventory, that's an indication that we're probably going to see normal home price appreciation. If you go higher than 7 months, and the higher you go above that, that would be a stronger indication that you're going to see lower than normal home price appreciation. Quick to point out here, that does not mean depreciation. Does not mean that you're going to see house prices fall. It just means you might see 3% appreciation or 2% or 1%. It's actually very rare that home prices would fall like they did in the Great Recession. But that's what months of inventory can help us understand. Now, if it's below 6 months of inventory, that's a buy sign, meaning for JWB to acquire inventory, because what that means is that you're going to have upward pressure on pricing. And so since we started tracking this monthly back in 2014, we've been between maybe 3 to 5 months of inventory. And that's one of the reasons you've seen JWB buy way more properties every single year than we knew we were going to sell. It's because we saw that home prices in the future were going to go up. We wanted to account and get that land under our control so we could turn that into cash flowing assets in the future for all of you. So 3 months of inventory in March of 2019 it's a strong indication that home prices are going to go up. And guess what? In March of 2020, home prices went up, right? You start to see that. You still had 8,000 houses on the market. This was before the COVID effect here, but sales were way up, right? Went up to 2,800 sales in a month, still very strong. And months of inventory dropped, now under 3. When I saw 2 months of inventory, this is what I looked at. And I said, when people were saying, do you think that home prices are going to fall? In my mind, it wasn't like a feel thing for me. I ran the numbers and I said, well, how much would sales have to drop at the same inventory level for months of inventory to get to 6 to 7? And if I ran those numbers, I said, well, that's probably not likely, but maybe it'll happen. That would just indicate normal home price appreciation. If I really wanted to see when housing prices were going to fall, I would have to get 8, 10, 12 months of inventory, right? And you started to run those numbers and it just didn't seem likely to me. So that's how I use this number to be able to come strong with all of you and share the ideas that have rang true there. Now, as we fast forward to April 2021, which basically takes the most recent data into account, 3,600 homes on the market is an extreme shortage of inventory. It's shocking that it's that low. Sales that happened in March, which are reflected in April 2021 of 3,400, we have never seen that many sales in a month. And 1 month of inventory is staggeringly low. That's why you're seeing all these things change for a normal home buyer who's going out there to buy houses. If you're a normal home buyer in a normal market, you feel like you have, some control over this process. You feel like, you can go to an open house and you can meet, you'd be the only person in the open house and then you'd make an offer and you'd probably be the only person that would offer that day. And then there'd be some negotiating back and forth and, you'd have an appraisal contingency and you'd maybe you have a home inspection and, and then maybe something happens and you want the seller to pay for something on before you close, and maybe you get them to do that. None of that's happening right now. None of that is happening. When home buyers go to buy right now, it's a frenzy. It's because of this metric right here. There's 1 month of inventory on the market. They're going in, they're waiving appraisal contingencies. They're bringing additional capital to the closing table. They're giving over list price. There are entire companies now that help buyers create an offer to where it can be an all cash offer. So they don't, even though they need financing, that they don't create that offer because they know that the seller doesn't want to accept an offer that has financing because it slows the process down. Like, everything is different. And so again, that's what you feel is going on with your friends, family, neighbors when you're talking about it. This is a numerical way to justify that part of what is happening in the real estate market here. 1 month of inventory is way low.
Super, super low, man. And yeah, it's, being a resident here, you hear the stories all over the place, right? Like nobody here is buying a property without showing up either with an all cash offer or at least enough cash to sweeten the deal and overpay for a house and get into it. It's really, really impressive. And then you also hear the, 1 month of inventory. Nobody can find anything, right? Like the active investors, the flippers and these folks that are out there are really, really struggling finding these deals, which again goes back to the fact that you've been buying properties for the last, so many years, stacking it up. You bought over 600 last year, and you've been positioning yourself. And last but not least, I mean, you really explained it really well, man. But it just takes me back, man. When we talk March 2020, 2.97 months of inventory, it takes me back to when a bunch of people showed up for the first time to the Not Your Average Investor show. Everybody was worried about their money.
Yeah.
Everybody was, that really was a moment when it's like, man, it felt good to have a platform and give my boy GC a press conference and take the heat. All right. But when you showed up and said, man, I can tell you that nobody knows what's happening with COVID. It's an unprecedented scenario, but this little number right here, this 2.97 months of inventory, tells me that housing prices are not going down anytime soon. And you nailed it, right? Like, they've only gone astronomically up, and this number has continued to go down, which, again, makes me trust you, man. Like, it's clearly not going to be a lower price market anytime soon, right? So like, it is, we're there in this like appreciation phase.
Yeah. And that's why I think this is the best time, the very best time to be investing in real estate that I've ever seen in my career. And I'm not shy about telling people that because I believe it in my heart. When you look at the fact that you have the opportunity to acquire debt right now at insanely low interest rates, right? To be able to acquire debt for less than 4.25% interest and to have the option to hold on to that debt for 30 years, ask yourself as an investor, do you think you could make more than 4.25% interest on an investment, right? I think most of us can probably say, yes, I can find an investment that is risk-adjusted return that I'm going to make more than 4.25%. Well, you have the opportunity to borrow people's money, other people's money at call it less than 4.25%, right? To do that for 30 years, that's a huge generational wealth opportunity to do that, right? You have that opportunity to do that now, which we've never seen interest rates this low, coupled with the fact that I've never been more confident that home prices are going to rise over the next 12 months, right? And I don't think that you should be buying rental properties to look at what's happening over the next 12 months, right? Because you're into this for the full market cycle. That's how we don't become speculators, right? But the reality is that if you have the opportunity to get into an asset and you expect higher than normal home price appreciation over the next 12 months, probably a good idea, right? Like, I'm still going to say home prices or rental properties are a great investment in 2 years, because I'm going to look at the other asset classes. I'm going to compare where your money could be best served and the best risk-adjusted returns. And I have a feeling that I'm still going to conclude that rental properties are still going to be one of the best investments out there and the right one for many of you. But I'm not going to change my tune that 2 years from now is the best time to invest in rental properties, because I don't think you're going to see such low interest rates. And I don't think you're going to have such strong of an indication that you're going to get a short-term bump from home price appreciation.
Yeah, man. Makes a lot of sense. We were just talking about it in the chat of like how strong you're coming. And like, I'm just not used to you being so just, this is the best time, because you're so overly cautious. But
Yeah.
you know, it adds value to it adds validation to what you're saying. The fact that nobody here believes that in 2 years you're going to be saying this is the best time ever. You just happen to be saying it right now because you've been showing up for a year plus saying, hey, be careful, this and that. I've been trying to be the hype man and tell you to say stuff, and now you're actually saying it, which means it's not my influence. It's that you really believe it, man. So Gregg,
Feels weird, huh?
yeah, it feels like I'm not used to it yet, right? But like that, like it's been like 2 weeks since you started speaking so with so much conviction about it. And the first time you did it really took me aback, right? Like I was like, oh wow, I just lobbed that one up and he took a big swing on it. Some stuff must be changing. So makes me happy that I just closed on my second property. But I'm gonna frame this chart here, right? Denny Davis had he saw this coming, right? Denny Davies said, Gregg, Alex and you have a 20-year chart that shows a progression line of steady price appreciation somewhere around 4% over time in Jacksonville. Voila, here it is. In mid 2020s, you would show how Jacksonville price appreciation was below this line and would eventually come up to meet it. I haven't seen this chart in a while. Not anymore, Denny. And with massive price appreciation over the past few years, have we now shot significantly past this line in the Jacksonville market? So that's part one of the question. Part two is, knowing we will shoot even further past the line in 2021, at some point, we will need to come back and meet the line, correct? In other words, in the 2020s, we were below the line and eventually came to meet it in the 2010s. In the 2020s, if we operate above the 4% long-term line, won't then it all come down to meet it?
What an astute question and observation. I think that is really wonderful, Denny. And I think you're on point with a lot of your analysis there. But I don't think that there's pause or cause for concern there. I wanted to make sure we showed this graph because I want to show you what's going to be happening over the next 1 to 2 to 3 years. Right now you can see this graph and you see all the blue lines, the blue jagged lines, right? Those are the actual home prices that have happened since 2001 all the way to 2021. And that red line that's going through the middle, it's red, right, Pablo?
That's right, it's red.
That's red. Nailed it. Colorblind guy right here. That is the median projected home sales price based on our historical average, right? So 4.3% each year is what this goes up. A couple key takeaways. We talk about home prices being cyclical, right? Home prices come back because of supply and demand and home price affordability. They come back to the norm. Use this information to your advantage to make the right decision for yourself and buy and hold, right? One incredible data point that everybody should look to is, the Great Recession was probably the most volatile real estate market we hope we will ever see and probably will be, right? If you go back from 2001 to 2021 and you follow that trend line right there, it goes up 4.3% each year. We're now meeting it in 2021. That means that over the last full real estate cycle, what I just shared with you about real estate being cyclical absolutely rang true. In the most volatile time when prices ran way up during the Great Recession, they ran way up prior to the Great Recession, then they fell after the Great Recession, it still rang true. So one could conclude that as this has happened decade after decade after decade, this was the biggest stress test that we probably have seen. You still hit this long-term 4.3% trend line. So use that to your advantage. Danny, to your question, what's going to happen over the next real estate cycle is probably going to be roughly the same end result. That's why I love investing in rental properties so much, because you sort of have the answers to the test as long as you hold on long enough, right? So even though I'm sitting here telling you that I expect home prices to jump more in the next 12 months than I expected and that more than happened last year, I still believe, and the reason I put my own money into this, that when I'm looking back over 10, 15, or 20-year segments from right now, I'm still going to see roughly 4%, 4.3% average annualized appreciation year over year. What I think you're going to see, especially over the next coming years, is you're going to see us go above that line. Okay. Now, the fact that the actual home prices would be above that line is not, you shouldn't just look at that in a vacuum and say, wow, we're an overpriced market or that home values are going to crash, right? That would be one indicator, right? That home prices are higher than the national median. That'd be one indicator that I would look at and say, all right, are we going to see higher than normal home price appreciation in the future or lower than normal, right? What I would see there, if we're way above the line, then we'd probably see lower than normal. Again, not the same as a crash, not the same as depreciating prices, just lower than normal. Another thing to look at, of course, is months of inventory, right? If you look at months of inventory and you see 15 months of inventory and we're way above the line, then my conversations with you will be something to the effect of, I see something seriously changing with prices in a negative direction at that point. But right now where we stand, we've never been lower for months of inventory. We are at the trend line right now, and it's very normal for us to go above the trend line. That's how this works. In a normal real estate cycle, you go above the trend line for a little while, then it smooths out, right? You have less than 4% appreciation as the trend line catches up. And then many times you don't drop prices, you might appreciate at 1% or 2% for a number of years or 0%, right? But it's just not normal that you have this crash. And so as I look forward into the future, I would expect us to see higher than normal home price appreciation, put us above that line. I think slowly but surely you're going to see months of inventory get more in line into that 6 to 7 range. And then you're going to see the same thing happen over the next real estate cycle, which is roughly about 4% appreciation, just with less swings, less run up before the Great Recession, less drop after the Great Recession, but you're ultimately going to get to the same answer.
Got it, Greg. So, graphically, what you're explaining to me is these swings, right? These micro swings that happen here are normal, and it's going to dance on this line. The big outlier that happened here was the idea that it went so far, like this delta right here is something that you don't see coming again. And we'll see it coming as it's happening, right? Like it's just more so that we've been used to this below the line consistently, but normally what's going to happen is it's just going to dance on this line with this level of variation, kind of a similar trend that's going to continue going up, as opposed to this like bubble that you see here, right?
Mm-hmm.
So like what we see here though is, number one, a giant delta between the median price and like what it's expected to be. You see this big thing, and then on top of that, like you said, right? What was months of inventory at this point? This is what, like around 2006 here?
Yeah, actually, I know it from December 2017. Months of inventory was 18 months of inventory.
18.
So if we got to a place where we were that above the trend line, actual home prices were that far above the trend line, and we had 18 months of inventory, I would be telling you prepare for another Great Recession. But I don't see that happening.
Yeah.
And even if that happened again, if you hold on for a full market cycle, you still wound up, in a place where your home prices actually got back to the norm of 4 to 4.3%.
Yeah, makes sense. I mean, you guys bought a bunch of your real estate here, right?
I did.
And you're still doing okay with it, right?
An interesting thing, because I'm seeing some of the chat here too, and I think this is a really good point. People say, well, Greg, if you go 20 years beyond, the numbers work. Try going 10 years beyond. Okay. Well, let's not even say that. Let's say that I took this trend line from 2006, right? If I did 2006 to 2021, I would not have appreciated at a rate of 4.3%, right? Okay. So you don't always know if it's going to be a 10-year, 15 or 20-year cycle, right? The reason that we call this cyclical is because as we look back over time and we see 10, 15, 20-year periods of time, you largely see that your appreciation rates on average are right around the historical norm. If you have a huge outlier like the Great Recession, you would expect that you need that full 20 years to get there, right? Right? You don't normally have that huge outlier like the Great Recession. But here's what's interesting. I'm talking about how market forces work in your favor. Supply, demand, home price affordability come together to ultimately, absent a large change in that region economically or livability or whatnot, absent that, you're going to see it come back to that same historical norm. Well, what's going to be happening here that I've just said over the next 2 to 3 years? right? You're going to see much higher than normal home price appreciation, right? If I took this chart just from 2006 and tried to make this, you know, as dire a situation as I wanted to, 2006, the height to where we are pricing right now is not 4.3%. I would imagine after the next 2 to 3 years, you're going to get closer to 4.3%, right? Because I'm saying home prices are going to go up so much, right? So it just goes to show you that these are how things work in real estate. It's why I love this asset class so much. I don't have to be Nostradamus here, right? I have to buy an asset. I have to be into it to buy and hold for a full real estate cycle to maximize the 5 profit centers. And I simply need to be in the game. And that gives me comfort. I understand this. Hopefully you all understand this. You don't have to understand different, things that the stock market really throws at you and all their indices and all of their metrics and what does this mean? And sometimes when you understand them, it doesn't even line up with what the actual stock price is doing. Like this is tangible. It makes sense, hopefully, for all of us. And a lot of this, I feel like you have the answers to the test as long as you're in the game long enough.
I love it, man. I'm gonna nerd out real quick, but did you ever play EA Sports video games growing up? That thing, how it, like I always start saying EA Sports, you're in the game. Like I
Yeah.
have this like vision of like JWB, you're in the game, right? Like you just
You want to
gotta.
know something? One of my all-time best moments is actually I was visiting a friend. This was back in college. I was visiting a friend and they were shooting the intro to the EA Sports like NCAA 2000 like basketball tournament or basketball show, game or whatever. Man, I'm out of my video game lingo here. Anyways, they were shooting the intro for it and we went and we auditioned and we got on the game. There you go.
Oh, that's amazing. That's amazing. All right.
So
Well, we won't nerd out too much there, but all right, cool. Jen Filson had a great question from before that I was waiting till now because it's more germane to the conversation. She asks, question. Some predictions for real estate say there may be a 20% market correction in 2022. What does Gregg feel is going to happen to JWB investors' positive cash flow properties in Jacks if house prices drop? So I guess, you've kind of disproven the idea that you think that, or at least it's clear that you don't think there's going to be a 20% drop in 2022, but maybe answer this in the macro. What happens if house prices drop? What happens to cash flow?
wonderful question. I wouldn't agree with that happening in 2022, but I think the cool thing is that you don't have to agree with me on this in order for this investment to make sense. Let's talk about worst case scenarios. Pablo knows me pretty well by now. He knows that a lot of times I think in what's the worst case scenario, and if it's okay, then I'm going to move forward and take a healthy amount of risk. Well, I lived through that worst case scenario, Jen, in 2006. I was a young kid, didn't have much real estate experience, didn't have much money, and just really fell in love with this asset class and bought about 40 rental properties with my business partners. And to do that, we learned how to use financing to our advantage. So we had these financed properties that we bought at the absolute height of the market. If you look at that absolute top part in 2006 on that graph, that's where I bought 40 rental properties. So I want you to know, Jen, that I know exactly what the worst case scenario looks like, because at that point, the market then proceeded to drop, call it 35% over the next 2+ years. So what happened to me? What really happened with those rental properties? Well, many people think that home prices and rents are directly correlated, and they're not. For me, as a kid who had a lot of debt at that time, good debt because it was on rental properties, and I didn't have a lot of income at that time, it was a fledgling business at that time. The only way I was able to hold on to those assets is because they produced positive cash flow month after month after month. Even as home prices were falling, rents stayed strong, again, because people needed a place to live. That's why I love this asset class. It's investing in a critical need. And as long as the jobs stayed in our local economy, which by and large part they did, the jobs provided the income for the renters to be able to pay for the rent, and the rents stayed consistent for us. So in a worst case scenario where you see a market crash, you have a couple of things working in your favor. Positive cash flow on the way in is a risk mitigating factor, right? That means that it can pay for itself it pays for itself every single month, no matter what housing prices do. So that mitigates your risk. That's why I went into this as a conservative guy and said, I'm going to buy 40 of these. It's because I knew that the fundamentals were that whatever housing prices did, the rents were going to pay all my payments for me. And so, and that's what we saw. That's a big reason why you need to choose a market that is built to withstand, some economic, built to withstand changes in the job fronts on the economy, right? You want to choose a market that has over 1 million people. Jacksonville has 1.5 million people because you want to have a diverse economy. We have 3 Fortune 500 companies. The Navy is the largest, and the military is the largest employer here in Jacksonville. We have Amazon distribution facilities. We're a logistics hub. We have the largest container port in the state of Florida, right? We talk about all of these things because that
Healthcare.
solidifies healthcare, right?
It's all-
Fintech. We're going to talk about fintech soon. We just confirmed the CEO of FIS, which is a Fortune 500 company. Gary Norcross is going to be joining us on the show in the not too distant future to talk about fintech and talk about Jacksonville. So anyways, you do all of that research. You make sure you're in an economy that you feel strong, that the job base is going to be strong, and it mitigates a lot of your risk. And for me personally, in that worst case scenario that I lived through, it actually wasn't a worst case scenario at all. It didn't affect my way of life at all. I didn't plan to sell those properties over the next 3 to 5 years anyways. I planned to hold them for cash flow. They did exactly like they were supposed to. And I still own them today. They're a part of my portfolio. So in the unlikely event that you would see a market crash in 2022, which I do not see, and many people in my space do not see, I think you're going to be fine. I'm still going to feel really good about telling people that this is a great decision, again, with the caveat that you're in it for the long haul. Because if you hold on for a full market cycle, that's how you win in rental properties.
Yeah, it makes sense, Greg. And to juxtapose that to other markets, right? Like it's a combination of all the things that work well inside Jacksonville, right? Because it is this idea of low pricing, higher rents, and this asset class. But I think what you hit on last there, the economical mix of Jacksonville is huge for the idea, and the fact that you are providing workforce housing is big for the idea of worst case scenario. Because Margaret puts in the chat, our rents crashed, tenants disappeared overnight, looking for where jobs are. They're in Sarasota, which is too heavily dependent on building trades, 2007, 2008, and that came to a sudden halt. So a national phenomenon is felt differently depending on your local situation. Me on the other side of the equation, when I was in my, I was in construction, working in the construction trades, definitely affected my livelihood. Came back to Miami, that's also super real estate and construction dependent, and highs and lows of that scenario. And the tourism dependency, right? Like, so when the economy isn't doing well, people aren't building a lot, people aren't traveling a lot. So if you're looking at those things, that's one. But logistics, healthcare, the military, government spending,
Yeah.
all that stuff is a big buoyant force of what the floor is, of what the worst case scenario is. Makes a ton of sense, man. Carl
Great point.
Thompson puts in here, where did you get your financing for those 40 properties in 2006?
The same way that I'm advising you to do it now. I mean, those were normal Fannie and Freddie loans. So the big difference there is when I was getting those loans in 2006, I thought it was a steal that my interest rates were 7% on the loans. And now they're, 4.25 or whatever they are, right around there. So yeah, it's the same thing everything I bring to you guys is exactly what I've lived and what I believe is the best risk adjusted returns on investment and really can help you long term. So it's the same thing.
There you go, Greg. So, we went a little over, we started late, man, but key takeaways, right? We're on the final slide here. What can you tell us? What do we need to really internalize from this report and from what's happening?
Our message, which started a year ago, has just gotten stronger and stronger and more validated over this year. And the more information that we see every single month, it hopefully everybody can see that there's a real methodology and strategy behind how we come to you, in an effort to prepare you for what's coming down the pike. So I think that you're starting to see this take shape even more every single month. I realize what I'm also doing on the show is even making stronger predictions about the future going forward. I recognize that. I do that because I think the data is stronger today than it was even 6 months ago or a year ago. But at the end of the day, it's the same way that we prepare you. It's the same database decisions. And what it is showing us is that there's extremely low inventory, low REOs, which stands for real estate owned. That means the foreclosures that have been owned by the banks. Of course, you would You would expect that to be very low as there's been a foreclosure moratorium. But even before COVID, there were very low REOs. Low interest rates, high net migration, so no dropping of prices anytime soon is a very conservative way for me to say this. REO sales are really low. I just wanted to give some credence to this. Many people say, well, once this foreclosure moratorium is over, that you're going to see a drop in the housing market. I don't see it that way. A normal market is about 10% of sales being REOs. If you go and look back pre-COVID, it was a lot less than that. In a real dropping market and the effects of the Great Recession, it was 30 to 40% of the inventory and sales on the market were REOs. So the key here, I think, is that you're going to see, even as foreclosures do go up in the coming years because of the economic pain that we're sort of hiding through a lot of the stimulus, there's lots of room to absorb this increase in foreclosures. And I still think we're going to see prices rise.
There you go, man. Strong market coming up. It's a good time to get in. You heard it from Gregg. It's the best time ever to get in, right? An uncommonly bold proclamation by you. And it's really been, it's been incredible to be part of this, man, to get this seat on this part of the bus of watching this market do what it's been doing has really been a phenomenal thing, man. I'm really, really glad that we've been able to kind of broadcast this message over the past year and a half, so that these words of, it's very different for me to say something's the best thing ever than you saying something is the best thing ever. And I think that's been proven. So it's been, I just think it's been a lot of fun to watch this happen. And I'm excited to be part of this whole asset class doing what it's doing from this seat over the next couple of years, because it's pretty clear it's going to be it's a rosy outlook, and it's always fun to kind of share good news than bad news.
It's going to be so fun to see as this plays out over the next 1 to 2 years,
Yeah.
right? Like, and everybody on the show gets to be along for the ride, right? This is not us just coming on strong, once a year and saying this is the way we think it's going to be, right? This is an every week thing. This is an twice a week thing. And we get to understand how this works. Ultimately, if you understand how this model works more and more, you're going to have more confidence to take advantage of it in the way that's best for your goals. And that's what's motivating Pablo and myself with this show, is bringing transparency, bringing this discussion to the forefront, because I do believe that there's a tremendous opportunity for those who really get it, especially now. And yeah, so I appreciate everybody for being here on the show. I appreciate all of you for making it what it is and giving the platform for Pablo and I to come a little stronger. But at the end of the day, I feel like we have an opportunity to really help people, and I feel that I need to let people know. So hopefully you guys are good with some of my bolder predictions.
Yeah. And if you want to get in the game, the address of the game is www.chatwithjwb.com, right? So if you want to hop on and find out what's for offer, see if this is good for you, get a personalized solution for it, chatwithjwb.com. Super easy. You hop on there, you pick a time that works for you, and you are all set up for a call with the team. This has been an awesome call. We had 60 plus people on with us to start. We still got 38 an hour and a half later. It never falls upon us, that never fails to amuse us that so many people take time out of their busy schedule to join us on a weekday. Thursday, we go back to the JWB Rental Income Property of the Week.
Week.
Hopefully with a fully functioning studio, if I don't do any crazy updates last minute that mess us all up. And hope to have you all on board and see you in the Facebook group. Gregg, I will leave you to last words, man. Great job today presenting the numbers and really bringing it home, man.
Well, thank you, brother. And thank you to everybody for being a part of this community. It gets bigger and better every single day. If you're not a part of the Facebook group, I'd love for you to join us there. And if you have any additional questions, fire into the group. I'm in there. You have a lot of other investors that can answer your question for you. You can go there at jwbfacebookgroup.com. And we'll see you on the show on Thursday. Take care, everybody.